Welcome back to the Future Show. Time for my chart of the day. Not the week the bulls were looking for if you're trading gold, that's for sure. While stocks really dominated the conversation this week, NVIDIA yesterday definitely highlighting that discussion. Gold kind of got overshadowed, right? And the move lower definitely was some miss by many, I think. Take a look here. Let's begin with that move lower this week. 5-minute candle chart and how gold has been on the retreat off those all-time highs we saw. 24, 54, 20, all the way down to, well, more than $100 lower, 23, 26, 30. You can see on this chart areas where the market's paused and kind of regained composure along this trajectory to the downside. You see very little in terms of any indication that we've rejected these lower levels, but I do want to point to how this moved lower this week off the all-time highs, again, on the top left to bottom right. You're going to see it's counter trend, right? Because here you can see on an hourly candle chart that we have been trending higher. We're going all the way back to the beginning of March when gold is trading around 2020, 2000. Here's that move we just looked at from 24.54 down to, again, the lower extreme, or nearing, I should say, the lower extreme of the range that we've been in since the beginning of April. That's, we'll call it 2270 up to 24.54. So again, range-bound contained type trade just off all-time highs, but possibly stacking up for a longer-term buy opportunity. Let's take a look. Speaking of longer-term and buy opportunities, we just got vertical out of a balance. We've been range-bound around this 1900 level, basically going back to the beginning of 2020. You can see that spike up to 2100. A couple key tops up at that level that we finally broke out of, if you remember, back in April, continuing, I should say, back in beginning of 2024, continuing into March, April, and now May. We've seen this bull market hold up, right? I mentioned no rejection of those lower levels in terms of the 5-minute candle chart, but if you're looking at this longer term chart, I think you can establish limited in terms of rejection at this upper level as of yet, right? Still hanging out just $100 off the all-time highs, and yeah, well off those lows on the bottom left corner of your screen when we were down around 500. I mean, again, sticking with that longer term chart here, you can see it does look like the bulls still remain in control. Not what they wanted to see this week by far, but hey, bigger picture is what we talk about here on the Future Show. Speaking of bigger picture, I wanted to have that discussion with our next guest and focus a bit more on the fundamentals behind the technicals and kind of focus on commodities in general, not just gold specifically. Alan Nuckman's here with us for that conversation, Chief Market Strategist at BullseyeOption.com. Alan, good to have you here. Let's begin. Good morning. Let's just begin simply with gold. Not the week the bulls were looking for. Higher for longer has them running for the hills.
Well, we're not higher for longer. We're here for longer. Now, that's a big difference. Now, you talked about Mr. Powell in the previous segment in great conversation. He's played this exactly perfectly. We've seen a stair step. Every time the market gets a little overexcited, he knocks it back down a little bit. So we'll see if we can bounce back as we've done every single time. People just have acrophobia at this time. We're in almost everything bull market, and people get fearful, and we take profits, from time to time. And that's good, and that's healthy for the overall bullish trends that we're seeing in almost everything out there.
Yeah, I like it. I've been calling it higher for longer, but I guess you're right? Here for longer.
Here for longer.
So we're going to add the IGH, drop the E, right? And ultimately we're on the same page here. But
right.
Talk to me, because we've had this discussion recently about this potential for commodity super cycle. Yeah. I guess following the data yesterday, I mean, that kind of feeds into that idea that you communicated a week or so ago to us. Don't be surprised if we see commodities continuing higher in this strong economic environment.
Yeah, definitely. To get back to gold, gold, if you adjust the price for inflation, you take the $800 high that we had back at whatever it was, 1980, and just for inflation, we still haven't made new highs. We'd have to get to 2,700. So there's still a lot more upside. And if you do that same thing for silver, you would have to adjust the 2011 high of around $50 to 69. And we're about halfway there. So there's still a lot more upside in these commodities markets. If you look at commodities as a basket, we're about halfway to the all-time highs. So I look at this as a great risk-reward area. I'll trade anything, anytime. I come on your other shows and I talk about options because I like the benefits of options. But I love the benefits of futures options. So the futures markets are where you and I both cut our teeth. And you can see I'm in my commodities corner. I've got iron ore, I've got copper, I've got gold ore behind me. So this is my business. I know the fundamentals of the commodity.
Sounds like you've got your eye on the ETF as well, GDX. Talk to us about what you're looking for there. Silver, you expect we could potentially double gold as well?
Yep. Right. Now, gold's already made a pretty big move. So you've got obviously some bigger risk of profit taking at any time, and that's what we're seeing this week. But I think the key is the dollar, and I have been under the impression that the dollar's not going to get stronger. We're going to have rate cuts eventually. It's not a matter of if, it's a matter of just when. We're still a 90%, 85% chance of one by the end of the year. Looking at GDX has been interesting because gold miners haven't really participated in this rally until just recently, in the last couple of weeks, last month. They finally made new highs, whereas gold's continue to be making new highs. So GDX is in a 15-year downtrend, has broken that downtrend angle. So if you look at that 67 high back in 2011, we're a long ways from there. We're on 36, 35 or something. So we're almost half. So the miners could be a great risk reward play. Obviously, they have the gold in the ground, and if the gold's at 2,400, 2,500, their value is going to be their cost per ounce is very, very low, a couple $100. So I think that's a pocket that people have to understand and expect. It's not a direct futures play. It's not a direct commodities play. It's indirect. But as I always say, it all comes back to commodities. Every investment that you do has some sort of basis in the fundamentals, the building blocks of the economy, which are the commodities. They could be interest rates. They could be the metals. They could be the grains. You could be oil. You have to understand what's going on with the commodities markets and the futures markets to make any intelligent investment.
Taking a look here at GDX, series of higher lows off that 2016 low we saw around 12. So definitely some momentum here to the upside, especially over the last couple months since the beginning of 2024. Hey, speaking of those larger building blocks of the economy, ultimately, one of the things we've heard a lot about this week with the NVIDIA results, all the focus on AI is this industrial revolution, this new industrial revolution that's taking place before our eyes, the impact that's going to have on copper, for example, tying into the electrical grid and some of the demands we're seeing for electricity. But we were talking in the office the other day, you mentioned natural gas, right? Where do we get electricity from ultimately? And this feeds into that discussion as well in terms of this commodity super cycle.
Yeah, and I love the chart pattern. I'm a technical guy when it comes down to it, but obviously I understand the fundamental story growing up in Upper Michigan in a mining town, understanding cycles and booms and busts and so forth. But if you look at natural gas has been down here so depressed for the longest period of time. Now, if you look historically, there's always some sort of catalyst that gives it a price bounce.
Yeah.
And that's how the markets work. We've been between 2 and 3 in natural gas for the longest period of time. Break out of this range, targets 4. We made a nice bottom. Whereas the fact that we made new lows but not new highs and implied volatility, that's a sign of a sentiment shift. And like I said, we're in an everything bull market. So the risk reward is definitely on the natural gas side. Now, like you talked, it could be the AI driver. It could be so many things. We've got weather concerns for the summer. We've got hot around the world. So that could drive up air conditioning. That could, electricity, grid problems. So there are so many things that natural gas could see a price pop. And that's always the idea behind commodities. There's price pop potential at any time in almost any one of these markets. Look at wheat, look at corn. Wheat's broken out. Corn looks like it as well. So we've got some commodities markets that are setting up for some potential, and potential just means it hasn't done yet, potential price pops.
Well, we always talk about the price probing process. So now if we add the price pop potential in there, try and say that 10 times fast, Alan. That would be very difficult. But okay, getting back to what you said here in terms of everything being in a bull market here type environment for these commodities, grains as well. Beans, wheat, corn have been lagging, but maybe starting to turn around a bit here now.
Right. Corn's been between $4.50 and $5.50 a year. So the risk reward, I don't see a whole lot more downside unless we have a perfect growing season. And I'm not going to predict that. There's always variables come into play. Mother Nature is very uncertain. So, look at what happened in Brazil with all the flooding. Anything can happen. So what's the potential? The potential is for a pop if there is any disruption. And that's what these markets are all about. And that's what we want to take advantage of financially. That's what we speculated on. Now, I use limited risk options, so I sleep well at night. But if you've got great timing and you're a better trader than I am, you can do the futures plays, and we understand the leverage of these contracts, produce big payoffs. There's also ETFs that track these markets as well. So it's maybe not as correlated, maybe not a pure play, but there's a lot of these opportunities. And to get back to the AI thing, when you and I were younger, Ben, the futures markets did not trade 24 hours, and they didn't take stops at nights for most of the commodities. So now the markets are efficient. We can control our risk so much better. So there should be no fear of trading in these futures markets, because you can control when you want to get in, when you want to get out efficiently, tight spreads, low commissions. So it's all there to take advantage of these opportunities. There are endless now. We have endless opportunity.
Alan, I really like that, because a lot of our viewers are either kind of just dipping their toe into futures, right, starting to learn about them, or getting a little bit more involved in. So I think that's important to remind them that there are a lot of different ways, angles to approach this, the opportunities that options present themselves with futures. Right. I think it would be a great discussion to have you back for in the near future. So we'll definitely try and book that. I appreciate you joining us here. A solid look at commodities. Go ahead, Alan. Last final thought into the holiday weekend.
I'll put you down. We'll do a regular options segment on commodities. It's just options are options. It just happens to be we'll have underlying futures contracts, and there's actually super beneficial. There are actually better payoffs than regular conventional stock options. So we'll get into that another day.
Okay. Alan Nuckman joining us. Appreciate the offer, and we'll definitely take you up on that, as well as the discussion. Chief Market Strategist at bullseyeoption.com. Alan, enjoy your long holiday weekend. We're going to take a quick break. When we come back, we're going to have durable goods orders headed your way. We've got Scott Bauer, CEO of Prosper Trading Academy, joining us for a look at the numbers. We're going to talk currencies and treasuries with Scott. And then Jenny Horn's here. She's got her eye on Intuit and Workday headed into the